I am Lindsey Bell. I'm Ally Invest Chief Investment Strategist. And I too want to welcome you to our second digital conference. This is part of our new educational series that focuses on helping you get smarter about investing. And talk about a great timing. I mean, volatility really has returned in the last couple weeks with larger than normal daily swings in stocks. But don't worry about that. My colleague, Callie Cox, a senior investment strategist on the team here, and we're here to help you learn to embrace uncertainty with our presentation this morning.
That's right. We're here to be your financial ally, and we're so excited to be here.
All right, let's get right into it. This slide here is kind of our agenda. It's going to serve as our roadmap with you all for the next 40 minutes of our presentation. We're going to start by assessing the market landscape. What does it currently look like? It sure has been a wild ride over the last couple months, which can be nerve-wracking, especially if you're new to investing. But smart investors don't let that get to them. They figure out how to invest in the environment that they're given. And we're going to try to help you do that. We're going to do that by giving you tips for investing in uncertain times. And then we're going to help you get started because, my friends, getting started is sometimes the hardest part of the process. Before we dig into all these topics and more, I just want to remind our viewers, you've been super active in chat this morning, and we love that so far. Keep up the good work. But Callie and I are going to answer your questions at the end of this presentation right here live. So make sure you stick around for the whole presentation. Get your questions over there in the chat box on the right, and we'll do our best to get to all of them by the end. So let's talk about the market landscape. Where are we? Well, let's start with pros and cons. Just like life, the market has pros and cons, or as I might say, there's some current concerns and then there's some mitigating factors. And since I'm a glass half full type of gal, let's start with the pros or mitigating factors. When I think about the market landscape, where we've gone and where we've been over the last few months, what has really driven the fantastic rebound that we've seen since that March 23rd low? Well, a big part of that really was related to the significant fiscal and monetary stimulus that was put into place by the government and the Federal Reserve. And we're going to dig more into that later in this presentation. But the CBO estimates that the amount of stimulus in the market right now, it equates to about 25% of GDP. That's no small number. So our policymakers are doing the best that they can to help stabilize the economy and ultimately the stock market too. So what that has done is point two under pros. That's helped ease financial conditions. And this is important because what this means, it sounds like fancy terminology, right? What it means is when you ease financial conditions, you're increasing the ability for people to access and companies to access loans and credits. We need money to be flowing to individuals and corporations to keep our economy going. And because the Fed has done that and financial conditions have eased, we've seen improving economic data. Heck, the City Economic Surprise Index is one indicator that we look at often. It measures basically how economic data is coming in versus what the pros think it's going to come in at. And the surprise has been to the upside, which is a good thing. Look, this week, new home sales, they were blockbuster numbers. Retail sales, much better than expected. Consumer confidence is on the rise, and we're even seeing some improvement in manufacturing. So this is all very good. And that's because the economy, the last point here, is reopening, which I make a note in parentheses that can be a pro and a con. And the con really lies in the top con on our list here is that reopening of the economy we've seen has led to an increased number of coronavirus cases. Isn't that right, Callie?
Yeah, that's definitely right, Lindsey. And if Lindsey is the glass half full type of gal, I guess I'm the glass half empty type of gal. And I'll walk you through the cons. So as Lindsey mentioned, coronavirus is one of the biggest cons out there right now. It's a terrible and devastating situation. And we've done a lot to flatten the curve over the past few months. But there are still hotspots popping up every day, especially around where we're based in Charlotte. So coronavirus is something to consider. It's a great health risk, but it's also a huge market risk as well. investors are trying to gauge demand and where the economy is going to go over the next, 3 to 6, 9 months, even a year. And it's hard to really guess because it's all dependent on the pandemic. So kind of going off of that, most of our cons kind of wrap into that. I mean, right now, companies aren't making a lot of money. S&P 500 earnings estimates have plummeted this year as companies have come out and said, we think this might be a tough year. We're not seeing the demand that we thought we'd see at the beginning of the year. And stocks tend to follow earnings estimates long term. So, earnings are something to consider. It is one of the fundamentals we like to consider. And as Lindsey mentioned, we're seeing a fierce recovery in economic data, but the economy is still fragile. I'll get into this later in the presentation, but the job market, the May jobs report was a gangbusters report. You probably saw it on the news, but we're still looking at about 20 million people unemployed right now. That's a huge number. And there's still obvious nervousness in the market. The 10-year Treasury yield is near a record low at 70 basis points. That's 0.7%. And as bond prices go up, yields go down. So obviously, we're seeing a lot of investors hide out in treasuries. Gold also reached a 7-year high this week, showing that investors are flocking into gold for safety as well. Lots of nervousness in the markets. And there's also geopolitical and trade tensions. That's always a risk out there. We like to call those more black swan events, events you don't really see coming. But, trade tensions are simmering. We have seen them pop up in the past few weeks, and that's another thing investors are watching. So that's a lot to think about. Where do we go from here, Lindsey?
I wish I could tell you for certain, but what I think what we can look at to figure out where we're going to go is some of the drivers that we have historically seen drive the market. There seems to be some disconnects really all over the place with regards to the market and the economy and other things. You read about it all the time, the disconnect between Wall Street and Main Street. So what's going on? Well, this slide right here, we're going to talk about the disconnect between earnings and the stock market. The reason we're looking at earnings is the way I like to think about the stock market. It's not that much different in a way. Work with me here. It's not that much different in a way from if you or I decided to go on a long road trip, say from New York City, where I'm at right now, to Texas or to Detroit or maybe to Florida. Maybe I want to go to a beach, right? That's a long road trip, right? Well, what will we do? We would pull out our Waze, our GPS. Maybe if you're old school, you pull out a map, and you would use that to find your direction to where you're going. Well, the market very similarly uses different indicators to figure out where it's going. And earnings has historically been one of the best indicators of where stocks are going to go in the future. Let me break it down for you like this. Quarterly earnings growth on average since 2005 has averaged 8%. If you look at the long-term history of the stock market, the returns that we've seen in the S&P 500 has averaged about 8% annually. So 8% earnings growth, 8% annual lift or return in stocks. That means there's they're highly correlated, or there's a big connection between the two. So that's why we oftentimes look at and start at earnings when we're thinking about not only individual stocks, but also the stock market overall. You can look at S&P 500 consensus estimate earnings, which is what we're looking at here. And now the market can, in some cases, lead earnings, but usually they work pretty closely together. And what you're seeing here, we don't have to go through all the numbers, but this is earnings growth expectations as determined by a group of analysts across Wall Street, where they think earnings growth is going to go in different quarters and in the years ahead. So on the left-hand side of the chart, you'll see quarterly earnings growth rate expectations. And on the right-hand side in the box, I'm going to focus on this black box here. You see full year 2020 and full year 2021 earnings growth estimates. The purple bar is where estimates were on March 1st before the coronavirus pandemic hit. And the pink bar represents where earnings estimates were as of June 16th. So the most recent data that we have. So what you see is going into the pandemic, Earnings growth this year was supposed to be, pretty decent, 5.4%, below that historical average I mentioned. But then the pandemic hit, the economy shut down, companies shut down, and estimates had to be revised sharply downward. Callie went over some of the economic data points, and that has led to this reduction in earnings estimates for a decline of 24%. That's a pretty big decline by historical standards, but not that far off from what we've seen in other deep recessions. Now you look at 2021 and you're seeing a huge rebound. Originally, we were thinking 11.3% growth for 2021. Now that's looking to be closer to 30%. Wow. Well, in reality, when you look at the actual dollar values of where earnings have been and where they're going, in 2019, we earned about $162 per share in S&P 500 earnings. That's exactly what analysts are expecting the market to earn in 2021. So basically, netting those over 2 years, you're going to get zero growth. But the market is already off to the races. That's a pretty big disconnect, if you ask me. So it's something that we're going to definitely keep our eyes on. The good news is it's not all bad news. The good news is that in the past 3 to 4 weeks, these estimates have really stabilized at these levels. And usually, historically, what we have seen is that when estimates stop declining, the market usually bottoms right around that point. So what's going to be key is watching what happens in the second quarter earnings period, which starts in July. We're going to hear from all sorts of companies about how their businesses are doing, and we're going to see if they're going to provide us any guidance. And then we're going to see where these numbers go. If they go down further, the stock market might, react negatively to that. If they move higher, the stock market could potentially react positively, or maybe it remains neutral given how far it's run. We're not entirely sure, but it's something that we're going to watch given that high correlation that I talked about. But Callie, this isn't the only way or indicator for direction for the stock market. Talk to us about something else that you've been looking at.
Sure. Well, let's talk about the economy, the second disconnect you need to watch in markets these days. So stocks follow two things over the long term. I know I said earnings. Lindsey talked to you about that. Stocks also follow the economy long term, although stocks are a leading indicator, so sometimes they do lead the economy. So right now, as I mentioned earlier, we're seeing lots of big surprises in economic data right now. So we're in a fierce recovery. There's no doubt about that. But there are still mixed signals. I mean, manufacturing hasn't picked up that quickly, and manufacturing is considered a bellwether for the economy and economic growth long term. And as we mentioned earlier, the economy is only partially reopened right now. So at least in Charlotte, I mean, restaurants can only take about 50% capacity at the moment, and it remains to be seen when everything will be fully reopened. So we could see some limited GDP growth from there. And when I say GDP, I mean gross domestic product. Just think of that as a general term for economic activity. So speaking of GDP, we do look at GDP estimates. And right now, economists are estimating that the second quarter, the quarter we're in right now, could be the biggest quarterly GDP drop on record. Look at the chart. They're expecting GDP to drop 35% on an annualized basis in the second quarter. That's a huge drop. And even if we see a V recovery in the economy, there still will be some long-term economic damage there. And investors are considering that right now. It's hard to know what the economy is going to look like a year from now. As I mentioned earlier, 20 million people are still out of work and collecting unemployment benefits. The unemployment rate is at 13.3%. That's a record high, and that's even after the economy started reopening. That was from May. So there are lots of things to consider out there, and I hate to be a big bummer, but they are things you should keep in mind when you're looking at the markets and where they're trading right now. Luckily, I do have one pro for you. As Lindsey mentioned, policymakers have taken notice of this. You know, the Fed has issued historic stimulus, and lawmakers have issued a historic stimulus package as well. That's the enhanced unemployment benefits and the stimulus checks you saw sent out over the past few months. So Lindsey can tell you more about that.
Yeah, so policy has been so important in this and every other recession really too. And, I'll get into the next slide after this one about the swift response that we have seen from policymakers, which has been really impressive, like you said. But policy can be another clue to where the market is going to go from here. It's not as strong as an indicator for the future prospects for the stock market as, say, actual economic data and earnings data. But it can provide information into the direction of economic data. It's kind of like an input into the economic data. So what we're looking at here is a chart of economic policy uncertainty. And I know what you're thinking, like, whoa, Lindsey, you're getting a little too deep in the weeds for me here. But stick with me for a second, because I think you're going to find this really interesting. And you can find this data on the internet for free. It's a Baker, Bloom, and Davis data set. And so the Economic Policy Uncertainty Index takes things into consideration like newspaper articles about economic uncertainty, different tax policies that are upcoming for potential change, because let's be real, like tax policies impact everybody's bottom line, not just corporations, yours too. And it also takes into consideration economic forecasts by the pros, because if there's a wide range of forecasts by the pros and they don't know where the economy is going, that means that there's not a clear policy set to determine the direction of the economy. And you could see, that uncertainty flow through to economic data. So look at this chart, the Economic Policy Uncertainty Index. You see it's interesting because you see it start to increase going into those gray bars right here. These indicate recessions. And you see it increasing going into each one of these recessions, and then usually peaking within the recession. This was kind of a little outlier here. And obviously we saw a humongous uptick recently in this index after the recession started in February. We got that news recently. And, policymakers were swift to react to the situation and stabilize not only the economy, the market. Callie talked about some of the things they did, but now the uncertainty lies in their fixes were kind of short term. They were, in most cases, lasted about 3 months. Things are currently evolving and changing, and some of these different policies are being extended for at least a period of time. But like Callie mentioned, we've got unemployment, the enhanced unemployment benefits. If you're receiving that extra $600 a week, that expires at the end of July. Additionally, there were temporary bans on evictions and foreclosures in some cities. Those will be expiring in July. So there's a couple of different things that are expiring. Most of the checks that people have received have gone out and have been spent at this point in time. There's a lot of talk about a phase 4 stimulus as the economy still works through this reopening, and we determine how quickly the reopening phase is going to be. But Congress, guess what? They go on vacation. They go on recess, I should say, at the beginning of July for 2 weeks. And so the likelihood of a phase 4 stimulus package getting through Congress sooner rather than later isn't looking great. There's a lot of disagreements on how big the package is going to be, what it's going to include, what it won't include. So hence a lot of uncertainty, right? So that's why it'll be interesting to watch this index. The latest data point we have is for May, when we did, I think it came down a little bit there, a tiny little bit, in response to, the actions that had been taken. But the question now is, what does the future hold? But to be sure, I'll just quickly go through this chart. This shows what policymakers have done so far. And as you can see, this talks about monetary policy, that's the Federal Reserve, what they do, and fiscal policy, that's what the government does and is responsible for. So I highlighted a couple of key points on this chart, right? About, the Fed was really the quickest to react. In early February, they cut interest rates. Then again, in mid-February, they just cut them all the way to zero ahead of their scheduled meeting to really signify how serious the situation was and how serious they were about working to combat the downturn that we were entering. And so between the Fed and Congress, there's been over $8 trillion in stimulus put into the system. And as you can see, it has helped stabilize financial markets. This is a chart of the S&P 500. And so with that swift decline, we saw a fast rebound as well. They've even the Fed has interestingly even ventured into unusual territories. You see, on May 11th, they announced their plans to buy corporate bond ETFs. That's something they haven't done in the past. And then on June 15th, just recently, they announced plans to begin buying corporate debt outright. So they're very committed to the cause here, and they're doing what they can to help corporations and the financial markets remain open. So we applaud them for what they've done, for lack of a better word. It's been unprecedented in what they have been able to achieve. The question is, where do we go from here? But we wanted to show that this has played a significant role in stabilizing the stock market near term. So, Callie, we see the rebound, the fall and the rebound. What do we do from here?
That's a great question, Lindsey, and I don't quite have the answer for you, although we have some tips coming up. But as you guys may have noticed, it's been a pretty rough year for the stock market. The S&P 500 fell 34% from February 19th to March 23rd. That's a month. That is a crazy fast decline, one of the fastest in history for a bear market. By the way, when we say bear, we mean a decline of 20% or more from record highs. I'll be saying bear and bull a lot in the next few slides, so I'll prompt you with that one. But it's been a crazy fast decline. It was a scary time, and it still is, a scary and uncertain time. Uncertainty is the buzzword these days. But we've seen an even quicker recovery on the other side. Stocks since March 23rd have recovered more than 40%, while the S&P 500 has. So, did we miss the opportunity of a lifetime? I'm not sure. Do you think so, Lindsey?
It's a good question. I'm not sure either. I mean, sure, if you could time the market, maybe we did, but not too many people, even the pros, will admit they're not very good at timing the market. So I think the important thing is to be invested in the market and to be continuously investing over time. But we understand that it can be. We went through a bunch of slides, Callie, to talk about how uncertain the environment we are operating in is. But that doesn't mean you should be afraid of investing in the market this time, right? I mean, I think right now it's time for us to give our viewers some tips on how to invest in this type of environment, don't you think?
Yeah, for sure. We've given you lots of questions, and now hopefully we'll give you some answers. By answers, I mean tips on investing in uncertain times, finding that uncertainty in uncertainty. All right, everybody, tip number 1, embrace the uncertainty. I know that's a tough thing to do. I mean, Lindsey and I struggle with it every single day. We have to write about these markets and watch them every day. But you need to embrace the uncertainty. Why? Because nobody has a crystal ball these days. Nobody has ever, and especially these days, they don't. Wall Street can make educated guesses on what's going to happen in the near term. We do it too, but that's what they are. They're educated guesses. But, life goes on, and you can't wait for certainty to wait for the best time to invest. So accept that your investing journey is going to have ups and downs. If you're going to kick off your investing journey now, you will go through rough patches, but don't worry. Don't lose hope. So rough patches, we've had a lot of them. Since 1950, we've seen 10 bear markets. Remember, that's a 20% or at least a 20% decline in the S&P 500 from record highs. We've seen 10 bear markets since 1950 and 11 economic recessions. That includes the recession we're in right now, the great financial crisis, which felt like the world was ending, frankly, the tech bubble, and the inflation panic of the 1980s. Those are just 4 of the 11 recessions we've seen since 1980. But guess what the S&P 500 has done over time? It's averaged 8% annual returns since 1950, despite all of those setbacks. That's the long-term power of investing in stocks, and that's why you don't lose hope when you see a stock market decline. All right, well, I know the obvious thing here. You're like, come on, Callie, I'm not going to invest for 70 years. And I get it. I'm not going to invest for 70 years either. Maybe I will. Maybe I'll live that long. Who knows? That'd be great. But let's look at shorter term returns on stocks, because I think you'll be surprised by this. So the S&P 500 over the past 5 years has averaged 8% annual returns. That's right, the same percent annual returns as we've seen since 1950. 8% annual returns, average annual returns over the past 5 years. All right, let's take it back 5 more years. I can't do my math. Let's take it back 5 more years. The 10-year average annual return of the S&P 500 has been 11%. And if you invested 10 years ago, it was kind of a lucky roll for you, because that was at the beginning of the S&P 500's 11-year bull market. Now, when I say bull market, I mean a 20% rise from the lows. So bull market is the opposite of a bear market. So yeah, at the beginning of, the last bull market started in March 2009. So if you invested 10 years ago, that's June 2010, you caught the beginning of the bull market, or what was essentially the beginning of the bull market. All right, let's walk it back 10 more years. The 20-year average annual return on the S&P 500 is 4%. And that was possibly the most unlucky time you could have invested in the stock market. That was near the height of the tech bubble in the early 2000s, when we saw excessive investor confidence in tech stocks. And then the bubble burst and the NASDAQ basically cut itself in half. So, you could throw your money in the market at any time during history, but chances are, if you stick in it for the long term, you could see positive annual returns. And that's why we say, don't lose hope and don't panic when you see the market go through a rough patch. Remember your goals. Don't make decisions based on where the market is going. Make decisions based on your goals. And hopefully, Lindsey can tell you a little bit more about that in the next slide. Tell us how to get started, Lindsey.
Right. Tip number 2 for how to get started is get started early. I know that sounds simple, right? And maybe somewhat annoying. How many times have you heard that, right? Do I sound like your mom reminding you to do the dishes? Anyway, it is though so important, and it's simple, but it's one of the most important things you can do for your investing and financial future. And look, if you're older and you haven't started now, no time like the present to start, right? But the earlier and the younger you are, the better it is for you to start. And that's because of this little thing called compounding. I'm sure you've heard of that term before, but I understand that it can oftentimes seem and feel like a little black box at times, but it is a mathematical concept that Albert Einstein once called the 8th wonder of the world. Albert Einstein, guys, that's a big deal. But it's also, as we say here, it's the exponential snowball effect of earning on top of your returns. And that can happen over a long period of time. So if you can invest as little as $20 a month or less. Is my slide showing now? It looks
Eric
like
said yes.
Okay, sorry, little technical. We're all remote here, but working from home. So this is an impressive feat that we're taking on with this digital conference. But anyway, so you can start with a very small amount of money. And look, we show this hypothetical example here with investing $20 a month over 20 years, over 10 years, over 5 years. And you could see the difference here. And look, we're assuming there's no fees. In the S&P, it's an S&P 500 fund. We're assuming there's no fees. We're assuming you earn that 8% annual return that Callie talked about. And look at what happens if you do that for 20 years consistently. This purple line here, you can end up with almost $12,000 20 years from now. You know how much money you actually put into the market? $4,800. So you're making 3 times of what you put in with just $20. Think about that. That's, Callie will probably kill me, but if I say, that's four coffees, and over the course of a month, or maybe a couple cocktails, whatever your vice is, I guess. But anyway, the point is that starting early makes a huge difference, because look, if I started doing that only 5 years ago, I only have $1,470. So it's a wide difference, and it's really your money is doing the work for you, right? Nothing better than that. So don't miss out on starting early. The other 2 things I would note that this slide doesn't say: starting early is the most important, but you don't have to start with a lot of money. You don't have to have $500 a month to put in the market. If you have $20, $5, just get started. That is the most important thing. The second most important thing is consistently putting money in the market, because like we already talked about, you're never going to be able to time the bottom of the market. So if you're consistently putting money over time, sure, you might end up buying some securities a little bit higher and at other times a little bit lower. But being consistent over time can make a huge difference. But with that, Callie, we already know, don't be afraid of uncertainty and get started early. What's the next tip you've got for us?
Well, Lindsey, the next tip is a big one, and Wall Street loves to preach about it. So Lindsey actually mentioned one of the biggest pieces of advice that I hate to hear in her last slide. So Wall Street will tell you, forego your daily coffee and you'll become a millionaire. That is the biggest hogwash I have ever heard. First of all, I am a coffee nerd, and I drink multiple cups of coffee a day. So I don't want to give up my coffee. But let me tell you, that is not the way to getting to your financial future or hitting your goals. We're telling you the tips that you need to know in order to hit those goals, and compounding is a big one. The third one, diversify. Diversify. I can't say it enough. Wall Street will tell you to diversify, but let me unpack it for you for a second. Diversification is essentially the investing equivalent of not putting all your eggs in one basket. It's spreading your money out between more aggressive assets, think stocks, and safer assets, like bonds. Safer, conservative, they all kind of mean the same. Aggressive and conservative assets. Spread your money out across several assets. Because look, market swings are not easy to stomach, and everybody has a different risk tolerance. When I say risk tolerance, I mean your ability to take the market ups and downs on the way to your goals. Diversification can help so much for this. It can ease any investing anxiety you have. And I think this year is a great example of how the diversified investor can come out at the top. Diversification is also an important thing to remember if you have a shorter time horizon to your goals. Let's say in 5 years, you want to, take some money out and maybe buy a house in Hawaii. First of all, if you're doing that, let me know. I want to be your best friend, use that beach house. But, if you have a shorter time horizon, bear markets like the one we've seen this year can, hit the money that you have in the market pretty hard. So maybe diversification helps you sleep a little bit better at night. All right, so let's look at what happened this year to the investor in a hypothetical 60-40 stocks and bonds portfolio. I say it's hypothetical because it is. I mean, this probably doesn't model out exactly like the same portfolio that everybody, like any investor has out there. It's just a hypothetical on our end, but it does demonstrate the power of diversification. So let's go back to that hypothetical S&P 500 fund example that Lindsey was telling you about in the compounding slide. If you were invested in that fund this year, you would have lost a maximum of 31% at the height of the sell-off. That's huge. But if you decided to diversify and you stuck 60% of your money in that hypothetical S&P 500 fund, but 40% of your money in a diversified portfolio of bonds, hypothetically again, you would have lost a max of 19%. And you would actually be up on the year right now. That's the power of diversification. And, there's always cons with pros. So I have to mention the con here. If you diversify, you might miss out on some returns on the upper end. You're taking less risk in your portfolio, so you might make less return. But that might be a good trade to make if it helps you sleep at night. So remember, diversify, especially if you have a lower risk tolerance. And if you do, that's okay. We're all different. And I'm so excited to tell you about the last one. It's personally my favorite, so we'll flip on to that.
Well, before I flip on, Callie, I just wanted to remind our viewers, if you haven't seen the agenda, Callie did an excellent job explaining diversification 101 to you, but we've got Ben Carlson coming up after us from Ritholtz Wealth. He's going to go even deeper and make you guys pretty much a pro at this. So be sure to stick around after our presentation for his presentation. But on to the next slide.
Yeah, good call out, Lindsey. I didn't forget you, Ben. Ben will be great, so stay on for that. All right, so arguably the most important tip, and it's also great life advice, keep calm and avoid emotional investing. That's right. Try to remove your emotions from your portfolio. So what does that mean? Well, it's essentially like keep your eye on your goals. And like I mentioned earlier, don't make decisions in your portfolio or investing journey based on what the market is doing. Keep calm, keep investing. So let's talk about panic selling, because panic selling is a term that Wall Street likes to throw around and is very much a thing. Panic selling is the act of selling just because the market is falling. It's very common. And if you watch the markets on a day-to-day basis, you'll notice that when stocks start selling off and they hit certain points, the sell-off intensifies, it gets worse. And then we have a 5% down day or a 10% down day, both of which we have seen this year. It's been a rough year. But panic selling is very much a thing, but you don't have to panic sell. And the best investors learn to not panic sell or panic buy. And, it's also important to keep in mind that stocks' biggest up and down days tend to cluster together. So it is a futile exercise to try and time the market. I mean, look at March, look at the chart on the screen. We saw over the past 12 months, we've seen the 10 biggest up days and 9 of the 10 biggest down days occur between February 19th and April 10th. So, you might sell out of the market and time it well enough to kind of miss that 10% drawdown. But if you sell out, you have to get back in to enjoy the 40% rebound. All of that is a wash when you consider your goals and you kind of stay invested in the market and stick in it for the long term. So it's so important to remember your goals. And going back to diversification, if you don't like those market swings, if you find that it's hard to keep calm when you see the market going through a rough patch, diversify. That helps so much. And yeah, that's my favorite tip. By the way, this is a lot to digest. So if you have any questions, please drop them in the chat. Lindsey and I will get to them after our presentation. So with that, I'll flip it back over to Lindsey.
We will definitely get to those questions. I know there's some great ones already coming in, so keep them coming. So Callie, all right, everyone knows we've laid it out for them. We're operating in uncertain times, but I think we've given our viewers the confidence that they can do this. They're going to be great investors, long-term investors, hopefully. But let's help them get started, because I always find this is really can be one of the most difficult stages of the investing process, right? So how do we get started?
All right, I'll tell you, and I hope you're fired up because we're about to make a plan and put it into action. Okay, so you want to invest? Where do you start? Well, we have a 3-step plan to get your financial house in order. First step, pay down your debt. And when I say debt, I'm talking about high interest debt, because debt can be a tool for investing, but high interest debt can seriously eat into the gains that you might see in your investing portfolio. Okay, when I say high interest debt, I mean the 15 to 20% rates you see on like credit cards and personal loans that you need to pay off instantly. So before you start considering investing, we recommend that you pay off that debt. Think of it as a seesaw. So if you're making that 8% average annual return that we've mentioned so many times in this presentation, but you're paying out a 15% interest rate to credit cards, you are losing money. So take that into consideration when you have some high interest debt sitting on the side. You can start investing with high interest debt or any debt on your balance sheet, or, any debt that you own, but, it might not be the wisest thing to do. All right. So second step here is to build up your emergency fund. Another thing that Wall Street loves to tell you, but I'll break it down for you here. So we all know that we have rainy days. I mean, right now could be one of those rainy days for you. It is a rough economy at the moment, like we talked about, but save up some money, put 3 to 6 months worth of expenses in a savings account, just in case you hit that rainy day. Maybe you lose your job. Maybe you have a health emergency. Maybe your dog breaks his leg. You never know. By the way, I'm sorry if that happened, but it is so important to stick some money out on the side so you're prepared when life kind of goes against you. And it helps embolden you when you do finally start investing, because you have this money out to the side, so you're not stressed out when you do start putting that $20, $30, $100 per month into the market, because you have your buffer on the side. It's your cushion. It's your sanity check. I'll call it a sanity check. All right. So step 3, Let's say you paid down your high interest debt, you built your emergency fund, and now you're ready. You're like, get me going here. Okay, start small. If you do all of these steps and you say, wow, I don't have any money left, we get it. It's fine. Start small. Put maybe $5 a week into the market and see how that goes, because you may notice in your budget that you'll find a way to kind of find some money to put into the market or think of your future self with. You know, our rule of thumb here at Ally Invest, and one that you've probably heard, is we like to say save 20% of your post-tax income for investing in your future self. That's investing, saving, retirement, anything that will benefit your future self, maybe education. So 20%, that's a big chunk of your paycheck, and we get it. You don't have to do that right off the bat. Save $20 a week, $20 a month, and then slowly ramp up to that over time. It's okay. We're all figuring this out together. So, you know, it's fine if you have to start small. And I'll reiterate again, you don't have to go through these steps, but we highly recommend that you do. It is so important to get your financial house in order before you start investing. If you're not quite there yet, maybe start small and pay down your debt at the same time. That's fine too. Everybody is different. All right, Lindsey. So we want to get started. How do we get started?
Yeah. Well, once you have your financial house in order, it's time to get your plan, get your game plan together, right? And the first step in that process is determining what your goals are. Why are you investing? What is the purpose? And when do you need that money by? So do you need it 5, 10, 20 years from now? Is it just for retirement, or do you plan to buy a house along the way? Or are you planning to pay for a student's college education, or pay for a wedding, or some other big vacation or purchase that you're really excited to do in 5 years or something like that? I think you need to come up with your different goals and then determine what the timeline is for each of those goals. And then most importantly, in bullseye number 2 under determining your goals is how much cash you need right now. What are your expenses going to be over the next 1 to 3 years? Are you planning to buy a car maybe in 2 years from now? Do you have any other big purchases on the near-term horizon? We call that 1 to 3 year period more near term. And then that's going to determine what type of account makes the most sense for your needs. Of course, you hear everyone say one of the top rules of investing is if your company offers you a 401k plan, get in it, especially if they offer you a match. And that is true. That is true. But if you have other financial goals, that may not necessarily be the best type of account for you to and invest and save for nearer term goals. For example, like a 401k and an IRA, they have tax advantages, which is why they are great types of accounts. And especially if you get that match from your employer and your 401k. But you can't have access to that money until you reach a certain age, usually closer to retirement, at least without paying a penalty and taxes on that money. So if you need something a little more near term, like a car in 2 or 3 years, maybe you want to do a CD, you get a nice rate on a 2-year CD or an online savings account. Those types of accounts would go in your 1 to 3 year bucket. But an investment account or a brokerage account or a robo account might be something that you put money in for, a goal that you have 5 to 10 years out. You can also use it for retirement as well. But there is, with retirement and money you're not going to access for a long period of time, you want to take into consideration some of your tax implications. And you can find more information on that on our website as well, too. But so once you have your time horizon and your goals laid out, the next part of the plan is to figure out how you're going to pick your securities. The first bullseye under this column is consider your risk tolerance. And Callie kind of talked about what risk tolerance means. And, when I think about risk tolerance, it means how much money are you willing to lose in the near term for those longer term gains? Because, we're always, the way Callie and I think about investing is really from a longer term perspective. We're not day traders. So we're in it for the long haul because the returns are better over the long haul in most cases. So once you have your risk tolerance figured out, one thing you can take into consideration there is is the risk tolerance. It can oftentimes be exactly what Callie showed in that split portfolio between stocks and bonds. And the question is the age-old history of 60-40 split, 60% in stocks, 40% in bonds. Is that the right mix for you? And there are different rules of thumbs out there to determine how much of your money should be invested in stocks, because stocks, by the way, are a more risky asset. You're more likely that the downside in stocks is a little bit higher than, say, the downside in a fixed income instrument. In some cases, depending on what you're looking at, say, let's say a treasury yield. But one rule of thumb that I think about when I think about risk tolerance is the 110 minus your age. So if you're 40 years old, 110 minus your age says 70% of your portfolio should be in equities and the 30% left should be in fixed income. And that changes over time. So that's just one quick rule of thumb that you could use to take into consideration your risk tolerance. Then you want to consider diversifying across multiple types of securities within those asset classes. And again, Callie talked about it. I'm not going to beat this one down because Ben Carlson is going to really get into it in the next presentation. We have even a more advanced version of diversification that looks at more interesting asset classes in the afternoon with David Peltier. So be sure to tune in for that segment of today's conference. After you diversify across asset classes and then within asset classes, then you want to, another way you can think about diversification is what is your comfort level with individual securities versus ETFs? If you're new to investing, ETFs can really be a great way to get your toes wet, to really just get started. You could buy an index fund that follows the S&P 500. That's pretty easy to do, and you get your diversification, at least from an equities market perspective, doing something like that. But ETFs too, just because they're ETF doesn't mean they're automatically diversified. If you buy a tech sector ETF, you need to understand what is in that ETF. Also, you need to understand what fees are included in that ETF, because you're gonna have to, some of them you're gonna have to pay fees. We do offer on our Ally Invest platform several ETFs that have no fees. So there are plenty of them out there for you to consider as well. So then after you got your diversification down, if you're into individual securities or ETFs, then you can think about, am I going to be hands-on or hands-off? If doing all that process of figuring out diversification on my own sounds like a lot of work to you, maybe you're a hands-off investor, at least to get started. And that could be a good opportunity for you to consider a robo type of advisor or a managed portfolios that are already made. You just put your money in it, and the platform that you're investing in does all the work for you. They do the rebalancing, which is another topic that you're going to hear a lot about throughout the day. They do, they pick the securities for you, so you're invested across various types of asset classes and diversified within those asset classes. So it's a lot easier way, especially if you're new to investing, to dip your toes into it. But if you're a hands-on investor and you like to do your homework, we always recommend, no matter what you're investing in, even if from a robo-advisory perspective, make sure you do your homework and you understand where your money actually is at night. So after you got your hands full with that and you think you're feeling good about it, then it's time to get started. And how can Ally Invest help? Well, we've got a little bit of both, hands-on and hands-off for you. We'll start with the hands-on, or hands-off, excuse me, managed portfolios, hands-off. Our robo-advisory portfolios or managed portfolios, those terms can be used interchangeably. Robo-advisory is a more popular term. You can start investing in those with as little as $100. So it's not a big upfront commitment. And you can make plans to continuously invest, like Callie and I've been talking about all day. There's no advisory fees, no annual charges, and no rebalancing fees. We rebalance the portfolio regularly for you. So if you get overweight in a large cap index, because that index has been up the most in the quarter, we're going to rebalance that back down for you. The portfolios also include a mix of low-cost, diversified ETFs. The portfolios also serve different interests that you have or different goals that you have. We have tax optimized portfolios if you're looking to benefit from a tax perspective. We have income generating if you're maybe later stages in your investing cycle, and you're really all about income generating, less about growth. We also have our core, which is our basic portfolio, which does focus on growth. And then we also have ESG, which has become really popular and has been one of the better performing sectors in the quarter. Actually, we've seen a lot of funds flowing into our ESG portfolios as well as ESG funds in general. So it's become much more popular as people have become more interested in investing in a sustainable way for companies that are doing right by their employees, right by the communities that they operate in, and right by their shareholders as well. So we offer a whole plethora of different managed portfolios that could be a good fit for you. Then also we do self-directed trading, commission-free, just like the industry. We all went to that in the fall of last year. There's no account minimum, so you can really start with a little bit of money there. We offer a significant amount of investment choices for do-it-yourself investors. We have an ETF screening tool, which is a great way to find those ETFs you might be interested in. We offer all sorts of types of different stocks. A lot of those ETFs I mentioned earlier have no fees. So there's a lot you could do here. We offer really in-depth research and market analysis tools that support various types of strategies. At the end of today, you're going to learn about options, and our options guru, Brian Overby, he's going to show you our options trading platform and really get you familiarized with that and how you can take part in or experiment with options trading. All right, I'm going to just jump into Q&A here because we have about 9 minutes left, and I love it. You guys have been super inquisitive so far. Let's see, we might not be able to get to all of your questions, but we're going to do our best to get as many as we can. Callie, maybe you have a suggestion for this, but Monica asks, what affordable educational resources do you recommend outside of this conference? Are there any good books on investing for beginners?
That is a great question. Ooh, I'll have to think about that one. So books, I'll get to that in a second. I do have to do some self-promo. We do have something called the Ally Community Hub, which our parent company, Ally, sponsors. But Lindsey and I do post a weekly note on there every week. It's called the Weekly Viewpoint. It's more of a forward-looking note on what we think can happen in the markets based on trends that we see. At a minimum, it's just, look at this trend that we're watching. Maybe it's interesting. Maybe you should keep it in mind. So definitely check out our weekly note. We also put out quarterly outlooks, just kind of previewing the quarter coming up. Our next one's coming out in July. In terms of books, so I really there's a Sally Krawcheck book. It's called, I can't remember. I'm sorry. I'll have to get somebody. I
know which one you're talking about. I'm dropping on the title of it too. But a book that I do like is Rich Dad, Poor Dad. I think it's a great one for just thinking about your financial life in general. And then Benjamin Graham, he's the value investing father. He's got some good stuff out there too. And anything Warren Buffett, anything Warren Buffett is great to get started as well, because he's the true fundamental investor. And fundamental means looking at the fundamentals of corporations, sales growth, earnings growth, margin growth, and what it means for the potential stock appreciation. All right, next question. We've got a ton of questions here. Brian asks, can you have an account with both managed and self-directed trading at Ally Invest? And the answer is yes, you can absolutely have both. And we have plenty of customers that like to do both. They get started in one area and dip their toe in the other area. So yeah, we're all for you doing whatever it is the best for your investing style. And I didn't mention before, is we have an amazing customer service team. So no matter what type of account you have, we're available most of the time, 24/7. to answer your questions by phone, chat, email. So we're here for you. We are a true financial ally. Next question. Let's see. You guys are a smart bunch out there. Karina, when is a good time to be diversified? All the time. It's good to be diversified. That risk that Callie and I talked about, that's a great way to manage your risk and downside protection. And it helps you, as I know my friend David Peltier, who will speak later, will tell you, the goal of diversification is to minimize risk so that you can live another day to keep investing.
Yeah. I'll add something quick to that, Lindsey. So,
Sure.
If your horizon is a little bit longer, say that you're in your 20s and you're like, okay, I just want to save for retirement. It does make sense. I mean, especially considering that 110 minus your age rule, it makes sense to keep, a lot of your money in the more aggressive assets because you have time to grow that money. But it is also so important to keep a little bit in safer assets or more conservative assets like bonds, and then gradually roll, like throughout your life, throughout your investing journey, gradually roll more money into bonds. So by the time you want to take your money out, by the time you want to retire, or like I said, buy that house in Hawaii, you'll have your money protected, hopefully protected. Not everything is guaranteed, but, bonds have proven to be a safer asset over time. So it is very important to diversify. And there are other things you can diversify in as well. There's gold, there are high dividend stocks that might provide a safer profile if you want to invest in equities, but you don't, love the swings of higher growth stocks. So, maybe you have a long time to invest, but it is still very, very important to diversify.
Yeah, it is. We'll get. It's a great topic too, because it's one that does confuse people, and so that's why we're going to focus on it today with some of our other presenters. Callie, another question from Jizzle. Does it make sense to open a brokerage account to save money for a house in 5 years for a higher return than that of a CD? I know you had some 5-year returns for us earlier in the presentation.
Yeah, that's a tough one. By the way, I love your username, Jizzle. That is a tough one, and I can't give you advice, specified advice, but I would, 5 years is probably the minimum I would go to put your money in the market. Fun fact, the great financial crisis stocks took about 5 years to recover from the downturn we saw during the great financial crisis. So that is like a worst case scenario. That was a once in a lifetime type thing that happened. But it might be a good idea to stay diversified, Jizzle. I can't say that without wanting to laugh. It may be a better idea to, stay diversified if you are looking at a shorter term horizon. Maybe look at a 50-50 split, or maybe look at a smaller allocation to equities and maybe a higher allocation to safer assets, so you can make sure that your money is protected if you want to take it out in a few years.
Yeah, I mean, I would just add to that. I think 5 years, like Callie said, is the minimum. We would say you need to minimum timeline. You need to have your money in the market, and there's no certainty, but I think some of the 5-year returns that Callie highlighted have over the longer term have been pretty positive. And especially when you're in an environment like we are now with interest rates at zero and not a lot of other options out there, it could be something that you could consider. But if it's something that you're struggling with, absolutely talk to a financial advisor or professional for some advice there. There is a question from Comments 2017. What should I do with my 401k? I didn't know there were fees taken yearly, and now I want more control of that money because I am recently unemployed. Should I leave it alone or close it out? Well, I wouldn't necessarily close it out. It depends on what your personal situation is. But what I would suggest is if you have a 401k and you think the fees are too high, I'm not sure if this 401k is with an old employer or a current one, but if it's in an old employer, what you can consider doing is rolling that 401k over into an IRA account at a brokerage firm like an Ally Invest. And, we're here to help you hold your hand through that process. because you can roll that 401k into an IRA that is either just like we have on the page here, a managed portfolio, or self-directed, so you're in control of it. We don't charge any advisory fees. We don't charge any commissions on most securities. There's no account minimums. So rolling that into an IRA at another brokerage house will not only give you control because you can pick the securities that you want to be invested in, but it will also reduce the number of fees. And I think we're just about at time. Maybe we can quickly do just one more. Let's see.
We'll talk super fast.
Yes. Callie, just Armin had a ton of questions, and one that I'm seeing right here is on your slide about uncertainty, the first slide with the table with the returns. Do you adjust those returns? Here, I'll go up to it for components being added or subtracted. I'm assuming he means constituents. I know you're looking at the S&P 500, but.
Yeah, so that's a great question. I think you just missed the slide. Yeah. Go for it. That is a great question. And yes, we do adjust for constituents. That's members of an index. We do adjust for members of an index being added and deleted. And over the long term, that really is a wash. If you are an investor who wants to invest in the broader market, so you're looking at an S&P 500 fund of some sort, additions and deletions to an index will be a wash over the long term. But yeah, we do consider that. And I see we never made it to the slide, but I will add that this presentation will be posted on YouTube within the next few days. So definitely, go back and watch this, check out that slide. It's Embrace the Uncertainty. And that table is a history of bear markets in the S&P 500. So
yes, that is all the time we have. I know we didn't get to all of your questions. We're going to work with our marketing teams and compliance teams and figure out if there's a way we can respond to you in a timely fashion.